Imagine, just for a second, you wake up one morning and the news is flashing. $41 trillion. It's starting to vanish from the U.S. economy.
Sounds pretty dramatic, like something out of a thriller.
It really does. But here's the kicker. This isn't fiction. This is actually a red alert warning. It's being sounded right now by Bank of America and other top analysts too.
Wow. Okay.
So our mission on this deep dive today is to figure out, what's really driving this potential massive exodus of money? Who exactly is starting to pull their funds out? And maybe most importantly, what could this mean for you? For your savings, your job, even the future of the U.S. dollar itself.
That's the core question, isn't it?
Exactly. And we're basing this on some, frankly, startling new estimates that are doing the rounds in major financial institutions. And also, really central to our chat is a critical new research note from Bank of America.
Right. And that $41 trillion figure, I mean, the sheer scale is just astounding.
Yeah.
To put it in perspective, think about what it represents. It's basically decades of foreign investment piling into the U.S. We're talking equities, bonds, real estate reserves.
The bedrock, essentially.
Precisely. This foreign capital has historically been the foundation of America's economic strength. The U.S. benefited enormously, from being the preferred place for global wealth.
The safe haven.
The ultimate safe haven.
Yeah.
You had investors from China, Japan, Saudi Arabia, Europe, pouring trillions into U.S. assets. They trusted the stability, the security. But now they don't. Wow, that fundamental trust, it seems to be starting to shake. You can actually see it.
And it's not just theoretical, right? The sources point to actual outflows we've seen recently.
That's right, tangible movements.
Like China, for instance. They've cut their holdings of U.S. treasuries.
Down to their lowest level in, over 10 years?
Yeah, and Saudi Arabia is apparently selling off U.S. assets too, maybe more quietly.
Discreetly. And it's broader than that. You see central banks globally actively rebalancing their portfolios.
Shifting away from the dollar.
Shifting away from the dollar, yeah, and increasing their holdings in things like gold or maybe other currencies.
So these aren't just isolated incidents. It feels like a pattern.
It does look like a pattern. There's a kind of growing anxiety, you could say, among these foreign investors. It's becoming much more apparent.
Okay, so if we widen the lens, what are the big drivers here? The Bank of America report mentioned geopolitics.
Yes, geopolitical instability is definitely flagged as a primary factor. Think about it. The U.S. has ramped up trade tensions, especially with China. And there have been sweeping sanctions imposed on quite a few nations.
Actions that might serve immediate foreign policy goals, maybe?
Perhaps. But the crucial side effect, according to the report, is that they're undermining that long-term trust. Trust in the U.S. as a reliable economic partner.
So countries that felt safe holding U.S. assets, now they're worried.
They're expressing genuine fear. Fear of political retaliation, or even worse, having their assets frozen. That's a huge concern.
So it's not just about dollars and cents, it's about predictability, reliability.
Exactly. And speaking of reliability, another huge factor unsettling investors is the U.S. national debt.
Oh, yes. The elephant in the room.
A very large elephant. It's blown past $35 trillion now.
And still climbing fast.
At an alarming pace, yeah.
Yeah.
And foreign buyers, particularly from Asia and the Middle East, they're openly asking, is this sustainable?
Can the U.S. just keep borrowing like this?
Right. And will the U.S. just keep printing dollars to manage it, which effectively devalues the debt they hold?
Which makes holding treasury bonds look riskier.
Increasingly risky, yes. The higher that debt goes, the less attractive America starts to look as that safe haven.
Okay. Debt, geopolitics. What else? You mentioned the Fed earlier.
Right. The Federal Reserve's monetary policy adds another layer of complexity. Remember, after years of super low interest rates, the Fed did a very sharp pivot.
The aggressive rate hikes to fight inflation.
Exactly. Now, while the goal was price stability, those hikes also injected a lot of instability into the bond markets. They amplified recession fears, definitely.
And made foreign investors kind of second guess where the Fed was heading long term?
Precisely. It just added another layer of uncertainty onto what used to feel like a very predictable, very stable environment.
And maybe the biggest shift, structurally speaking, that the sources mention is this move towards de-dollarization.
Yes, that's accelerating. And it's not just talk anymore.
Not just rhetoric. We're seeing actual changes.
Concrete actions. The BRICS countries, Brazil, Russia, India, China, South Africa, there's certainly visible leaders in this.
But it's not just them, right?
Oh, far from it. Think about France, a key U.S. ally. They've done oil deals in Chinese yuan.
Interesting.
And the UAE and India are actively trying out payments in their own currencies, like the rupee.
So these aren't just one-offs.
No, these are like the early but quite clear signs of a really deep structural shift happening in global finance.
So putting it all together.
It adds up to a powerful signal. Foreign investors aren't blindly trusting the U.S. economy anymore. Not like they used to. They're hedging their bets. They're diversifying.
Yeah.
And in some cases, yeah, they're pulling significant capital out.
And that Bank of America note, it really spells this out.
It does. It explicitly warns that America's financial dominance isn't guaranteed anymore. That's a big statement.
No longer guaranteed.
Wow. They say the U.S. is entering a new era. Their phrase is structural vulnerability.
Structural vulnerability. That sounds serious.
It signifies that the very foundation, the foreign money flowing in, the global trust in the dollar, the constant demand for U.S. debt, that foundation is eroding.
It won't happen instantly, presumably.
No, not overnight. But the Bank of America analysts are strongly urging their clients to prepare.
Prepare for what, exactly?
Prepare for a world where U.S. assets might not be seen as the ultimate safe haven anymore. This is about a deep systemic shift.
And they point to specific evidence like the bond markets.
Yes. They highlight the dramatic decline in foreign participation in U.S. bond markets. That's critical. For decades, foreign central banks were the main buyers of U.S. treasuries. They basically underwrote America's borrowing.
And helped keep interest rates low.
Kept them remarkably low, yeah. But now, China's holdings are below $800 billion, first time since 2009.
Japan is selling off too.
Slowly, steadily divesting. Even traditional allies like Germany are reducing their exposure.
So Bank of America's warning is?
Their stark warning is, and I quote leasely, the marginal foreign buyer is disappearing.
The marginal foreign buyer disappearing. That sounds like it would have knock-on effects.
Huge ones. And that phrase leads straight to another key insight. The surge in interest in alternative assets.
Like gold.
Gold is the prime example. Central banks across the BRICS nations, the Middle East, even parts of Europe, they're buying gold reserves at the fastest pace seen in decades.
Why gold specifically?
Well, think about it. Gold isn't subject to U.S. sanctions. It's not directly tied to the Fed's policy whims.
So it's seen as a hedge.
The ultimate hedge, really. Against inflation, yes, but also, critically, against geopolitical risk.
So that gold buying isn't just a side story?
Not at all.
Yeah.
It's a direct symptom of that changing trust we talked about. It tells you exactly where confidence is shifting.
The sources also warn about something Bank of America calls the confidence spiral. That sounds ominous.
It is. It's not just a theory. We've seen it happen historically in financial crises.
How does it work?
Basically, as more investors start to doubt the long-term safety of U.S. assets, they begin pulling out.
Okay, that creates market volatility.
Exactly. And that volatility then reinforces the idea that, maybe the U.S. isn't so stable after all.
Which pushes even more capital to leave.
Precisely. It becomes self-reinforcing. Could you maybe expand on why that's so dangerous? What are the precedents?
Well, it's dangerous because it feeds on itself and can accelerate incredibly quickly.
Faster than policymakers can react.
Often much faster. History shows that once a confidence spiral really takes hold, perception can become reality very fast.
Can you give an example?
Sure, think about the Asian financial crisis back in the late 90s. Or even some elements of the 2008 global crisis. Initial doubts lead to money flowing out, which causes asset prices to drop.
Triggering more doubts, more outflows. A vicious cycle.
Exactly, and it's incredibly hard to stop once it gains momentum.
So Bank of America's warning here is that even small doubts today
could trigger a chain reaction. It could lead to a runaway effect where this capital flight becomes really difficult to control.
Unless there's serious fiscal reform and geopolitical stabilization.
That's a really powerful and, frankly, sobering assessment. It underscores the urgency.
It does.
Which makes you wonder, how are policymakers in Washington actually viewing all this?
Well, the Bank of America note warns that policymakers might be significantly underestimating the long-term impact of these shifts.
Really? Underestimating?
They suggest that, temporary fixes like small interest rate tweaks or maybe short-term wins on trade, they just won't solve this deeper problem.
So what's the conclusion from BOFA?
Their conclusion is pretty stark. Markets can handle risk, up to a point. But what they absolutely cannot endure forever is uncertainty. Especially uncertainty about the very foundation of global trust.
Okay, so let's bring this back to the listener. What does this all mean for you? If these warnings from Bank of America actually play out and capital really does start leaving the U.S. at scale, What
The
happens?
consequences could be severe, and they'd ripple through the whole economy.
Where would we see it first? Maybe the bond market?
That's likely. It's the backbone of government financing. If foreign investors buy fewer U.S. treasuries,
The government has to pay more to borrow.
significantly higher borrowing costs, yes. And remember that $35 trillion plus in debt.
Right.
Even a small increase, say 1 percentage point, in interest rates could cost the U.S. hundreds of billions more each year just in interest payments.
Which puts huge pressure on the budget.
Immense pressure. It could crowd out spending on other critical things, infrastructure, social programs, defense, you name it.
Okay, so that's the government's borrowing. What about the stock market?
That's the next domino. Foreign investors hold trillions in U.S. stocks. Tech, energy, banks,
Big players.
huge players. So a large-scale sell-off by them wouldn't just be a market correction. It could trigger a full-blown crisis of confidence.
Panic selling.
Once markets sense real panic, algorithms kick in, stop losses trigger, you could see a rapid cascade of selling. Indexes like the S&P 500 or the NASDAQ could plunge.
We've seen market crashes before, obviously.
We have, but this time the trigger wouldn't necessarily be a domestic issue like a housing bubble or a pandemic. It would be this profound global loss of faith in U.S. assets.
And then there's the dollar itself.
Yes, the U.S. dollar. As foreign countries hold fewer dollars in their reserves, maybe shifting to other currencies or commodities like gold,
The dollar could weaken.
potentially weaken dramatically. Now, on paper, a weaker dollar might help exports a bit.
But for the average person,
For you, the main impact would likely be a significant jump in the cost of imports.
everything from electronics to gas for the car?
Absolutely.
Yeah.
Everyday items. Which would inevitably mean inflation could come roaring back,
Hitting purchasing power hard.
directly impacting your wallet, yes. And there's another effect, maybe less talked about.
What's that?
The potential decline in foreign direct investment. Money flowing into real estate, infrastructure projects, new startups.
Ah, right. Cities rely on that.
Major cities, definitely. New York, Miami, LA. They depend heavily on these foreign capital inflows for growth, for development. A big pullback could mean layoffs, slower economic growth overall, falling tax revenues for states and cities.
So stepping back, the sources seem really clear on this.
Unequivocally clear. This potential flight of capital isn't just a headline for Wall Street financiers. It's a national risk. It touches jobs, interest rates, the prices you pay, and could even, down the line, affect political stability.
Okay, so as we sort of wrap up this deep dive, the core message seems pretty stark, this $41 trillion warning. It's not just a scary number designed to grab headlines.
No, it seems to reflect a real shift.
A fundamental shift in global sentiment. That trust, the trust that made the U.S. the financial center of the world, it's showing visible cracks.
Demonstrably starting to crack, as you said.
And as we've discussed, this isn't just Wall Street's problem. It's a national risk affecting, well, pretty much everything. Jobs, rates, prices, maybe even political stability.
And while the sources we looked at, including Bank of America, they don't give direct financial advice.
No buy or sell recommendations here.
Definitely not. But they strongly suggest that for you, listening now, staying informed is absolutely paramount.
What does that mean in practice?
It means maybe critically reassessing some old assumptions. The idea that the U.S. is just invincible, or that the dollar will always be dominant, or the stock market will always just bounce back eventually.
So don't take those for granted.
Exactly. Instead, there's to suggest that understanding the very real risks, capital flight, potential inflation spikes, currency devaluation, that understanding is the crucial first step.
The first step to protecting your own financial future.
That's the implication.
So maybe the real question isn't whether America can survive a shift like this.
But whether the leadership is actually ready for it, prepared.
Yeah. Is the leadership even ready? Because the historical lesson from these sources seems crystal clear. Capital moves fast, often much faster than governments can react.
That's a recurring theme in financial history.
And right now, according to these analysts, the early warning signs of a pretty significant shift, they're already flashing red.
Which brings us to a vital point for you, the listener. If even, say, half of what Bank of America is warning about actually comes true.
Then being proactive matters.
Immensely. Those who stay ahead of the curve, who really grasp these risks and adjust their thinking or planning accordingly, they won't just survive the potential turbulence, they stand a much better chance of actually thriving through it.
Which really reinforces why digging into these warnings now is so important.
Absolutely. Being informed is the best preparation.